In this video, we're going to take a look at why crude oil is such a popular market with traders and what drives the price. Hello, I'm David Jones from Capital.com, and this is the latest in our series looking at popular markets with traders. When it comes to crude oil, I think it has to be the most widely traded commodity around the world when it comes to traders trading markets. There are two different types of oil, so what I thought we'd do is take a look in this video in a bit more depth at the two most popular types, what drives the price and why traders like to trade it. Let's get started. So let's take a look at the crude oil market and why is it popular with traders. Oil has always been the most popular energy sector to trade. Supply and demand clearly plays a big factor here. If supply is constricted, let's say, for example, OPEC, the oil producing cartel, decide to cut back production of oil, then the price should rise because there's less oil available. On the other hand, if global economic growth slows down, factories are manufacturing less, for example, this results in a fall in energy requirements, then the risk is that the oil price will drop. There are two main types of oil to be traded, two popular ones. That's US crude, WTI, which stands for West Texas Intermediate, and the UK version, which is Brent crude. So these are the two main markets. So how do you trade oil with Capital.com? You trade using contracts for difference, CFDs. CFDs may be a term that you're familiar with. When you're trading using CFDs, you trade using leverage. Typically, lots of short-term traders use leverage. They're looking for relatively small price movements. Using leverage magnifies their potential profit. But of course, hand in hand with that goes the risk of magnifying your losses. So when trading using leverage, it's even more important than ever that you have some sort of risk management in place, such as stop losses. And also importantly, with CFDs, you can trade markets in both directions. If you think the price of oil is going to rise, then you'd buy using CFDs. But if you thought actually there was going to be a drop in the oil price, you'd sell short using CFDs. So you'd position yourself to profit from the price sliding. It's a major benefit of trading using CFDs. So let's take a look at what the price of oil has done just over the last 8 months or so. It's traded as high as, this is US crude oil that we're looking at, it's been as high as almost $77 a barrel. Then over the next few months, slipped down to below 43 and then bounced back to trade above 66. So it's been incredibly volatile over this monthly period. But let's take a look at the short term as well. So this is the last couple of days, and we can see just over this period, the price of oil has moved in more than a $2 range. So this sort of volatility is exactly the reason that oil remains such a popular market with traders around the world. So the two most popular markets, it's the US West Texas Intermediate crude and Brent crude. They tend to be the one that traders focus on. They like to trade it because of the volatility. You can see just over a couple of days we have plenty of swings in the price of oil, and you can take advantage of this with Capital.com by trading using CFDs. The benefit here is that if you think the price of oil is going to drop, you can position yourself to sell short, as well as just going long if you think the market is going to rise. You trade using leverage, and leverage in effect gives you more bang for your buck. It magnifies your potential profits, but hand in hand with that goes the risk of losing more money when using leverage. So it's really important, as I was saying, to have some sort of risk management in place, such as stop losses. But you can find out more about CFDs, contracts for difference, on the Capital.com website. That's our quick introduction to oil over. So from me, David Jones, and Capital.com, good luck with your trading.